Hi friends, my name is Krishna. Welcome back to my YouTube channel. Sorry for the last 2 weeks I couldn't upload any of the videos due to some personal works. Let us again continue with our journal entry discussions. Last video we discussed about journal entries for goods. In this video we are going to talk about asset related purchases. Let us say I purchased a machinery purchased for cash 1 lakh. Number 2, machinery purchased for credit 50,000. Number 3, machinery purchased from Raju 25,000. Let us discuss about these three different type of transactions. First one, machinery purchased for cash, right? Let us talk about this. So what did I say in my previous video? Let us talk this as we always need to prepare these journal entries from business point of view. From business point of view, when I purchase machinery for cash, I said we need to question two. One, what comes in, what goes out. When we purchase machinery for cash, what comes in? Machinery comes in, right? What goes out? Cash goes out. Simple. Machinery comes under what type of account? It is an asset, so it comes under real account. Cash comes under real account because this is also an asset. So what is the principle under real account? Debit what comes in, credit what goes out. What comes in here? Machinery. So machinery account has to be debited. Next, what goes out? Cash. What real account principle says? Debit what comes in and credit what goes out. Here what is going out? Cash. So to cash account. Simple. Clear? Let us move on to the second. What is that other transaction says? Machinery purchased for credit 50,000. In this case, we purchased a machinery, but transaction very clearly says purchased for credit. That means what? We did not pay the cash. So in this scenario, business point of view, when I purchase machinery for credit, what comes in? Machinery comes in, right? What goes out? Nothing goes out. Machinery comes in, nothing goes out, then next question is going to be, who is the giver of this machinery? Who is the giver? Name is not given in the transaction. If the name is not given in the transaction, let us consider this as creditor or supplier. Clear? Creditor, supplier, vendor, you can use any of the names, vendor, right? So machinery comes under what type of account? Real account. Creditor or supplier or vendor comes under which account? Personal account. Let us say, what is the principle under real account? Debit what comes in, credit what goes out. Right? Here machinery is coming in. So machinery account has to be debited. Machinery account has to be debited. What goes out? Nothing. If nothing goes out, what would be our next question? Who is the giver of this machinery? Who is the giver? Creditor or a vendor or a supplier is the giver. So comes under personal account. What is the principle under personal account? Debit the receiver, credit the giver. Is he a receiver or a giver? He is giving that machinery to our business. He is giving or he is supplying machinery to our business. He is the giver. So giver, what do we do with giver? Debit the receiver, credit the giver. He is the giver. So you need to credit creditor. or supplier or vendor. Clear? This is how the entry has to be prepared. Next. Let us move on to the next category. Machinery purchased from Raju, 25,000. In this transaction, did they say machinery purchased from Raju for cash? No. Nothing was mentioned about cash. So did they say machinery purchased from Raju for credit? Even credit they did not mention. What did they mention? Machinery purchased from Raju. Since cash is not mentioned in the transaction, cash or bank is not mentioned in the transaction, name is given, you need to consider this transaction as a credit transaction. Clear? You need to consider this transaction as a credit transaction. Now, again, from business point of view, two questions. What is the first question? What comes in? When I purchase machinery from Raju, what comes in? Machinery comes in. Clear? When we purchase machinery from Raju, this is for credit. That is what we decided, right? So if it is credit, what goes out? Nothing goes out. If nothing goes out, what should be your next question? Your next question should be, who is the giver of the machinery? Who is the giver? Raju is the giver of this machinery. Raju is the giver of the machinery. Now, machinery comes under what type of account? Real account. Raju comes under what type of account? Personal account. Clear? Now, real account principle. Debit, what comes in, credit, what goes out. What is coming here? Machinery. That is what is coming in. So you need to debit machinery account. Next, Raju comes under personal account. What is the principle under personal account? Debit, the receiver, credit, the giver. Raju is the giver. So credit the giver. So you need to credit to Raju account. Simple. This is how you need to understand, analyze the transactions and prepare journal entries. Now I took the example of machinery. You can take the same examples for furniture or vehicles or building or land. Any of the assets you take, same rule, same principle you need to apply and start preparing the journal entries, right? My next video is going to be on expenses. That is what I'm going to do in my next video. I hope you are clear on this topic, and if you like my video, please like the video, subscribe to my channel and share this video with your friends and colleagues. It will be very helpful for all of you. Thank you so much.